Hey traders, and welcome to the third video in this technical analysis trading course where we will be covering trend analysis. That will include 4 different chapters: the definition of trends, types of trends, support and resistance levels, and lastly trend lines and channels. So let's dive straight into the definition of trends. In technical analysis, a trend is defined as the general direction in which the price of a security is moving. Trends can be classified into 3 main types: uptrend, downtrend, and sideways trend or horizontal trend. It is important to note that trends can occur on different time frames, such as daily, weekly, or monthly charts. Traders often use multiple time frames to identify the overall trend and make trading decisions. Trends are an essential concept in technical analysis, as they provide valuable information about the direction of the market and potential trading opportunities. By understanding how to identify and analyze trends, traders can make more informed trading decisions and improve their chances of success. As we discussed earlier, trends are an important concept in technical analysis and can be classified into 3 main types: uptrend, downtrend, and sideways or horizontal trend. Let's take a closer look at each type of trend. An uptrend is characterized by a series of higher highs and higher lows. In other words, the price of a security is moving upward over time. This type of trend indicates that buyers are in control of the market and traders may look for buying opportunities to enter the market. A downtrend is characterized by a series of lower lows and lower highs. In other words, the price of a security is moving downward over time. This type of trend indicates that sellers are in control of the market and traders may look for selling opportunities to enter the market. A sideways or horizontal trend is characterized by a series of highs and lows that are roughly the same level. In other words, the price of a security is moving within a relatively narrow range with no clear direction up or down. This type of trend indicates that there is no clear dominance by buyers or sellers in the market, and traders may wait for a breakout or breakdown to occur before making a trading decision. In conclusion, understanding the different types of trends in technical analysis can help traders identify potential trading opportunities and make more informed trading decisions. By using technical analysis tools such as trend lines, moving averages, and chart patterns, traders can identify and analyze trends on various time frames to gain a better understanding of the market. Next up, support and resistance levels. Support and resistance levels are 2 of the most important concepts in technical analysis. They are areas on a chart where the price of a security tends to find support or resistance, respectively. A support level is a price level at which the demand for a security is strong enough to prevent the price from falling further. It is considered a floor or a base of the price action. A resistance level is a price level at which the supply of a security is strong enough to prevent the price from rising further. It is considered a ceiling or a top of the price action. When a security's price action approaches a support level, traders often look for buying opportunities, as there is a higher probability that the price will bounce off of the support level and begin to rise. Similarly, when a security's price approaches a resistance level, traders often look for selling opportunities, as there is a higher probability that the price will bounce off the resistance level and begin to fall. It is important to note that support and resistance levels are not always exact price levels. They can be zones or areas on a chart where the price tends to bounce or stall. In conclusion, support and resistance levels are important concepts in technical analysis that can help traders identify potential trading opportunities and make more informed trading decisions. By understanding how to identify and analyze support and resistance levels, traders can improve their chances of success in the market. And lastly, trend lines and channels. Trend lines and channels are technical analysis tools used by traders to identify and analyze trends in the market. They are drawn on a chart to connect the highs or lows of a security's price action. A trend line is a straight line that connects 2 or more price points and is used to identify the direction of a trend. An uptrend is a line drawn by connecting 2 or more consecutive lows, while a downtrend line is drawn by connecting 2 or more consecutive highs. Trend lines can be used by traders to identify potential areas of support or resistance, as the price of a security may bounce off a trend line and continue in the direction of the trend. A channel is formed when a trend line is drawn parallel to another trend line that connects the opposite side of the price action. A channel can be either upward sloping or downward sloping depending on the direction of the trend. Traders may look to buy when the price of a security bounces off the lower channel line in an uptrend channel, or sell when the price bounces off an upper channel line in a downtrend channel. It is important to note that trend lines and channels are not always exact price levels. They can be zones or areas on a chart where the price tends to bounce or stall. Traders often use a combination of technical analysis tools to identify and confirm trend lines and channels. In conclusion, trend lines and channels are important concepts in technical analysis that can help traders identify potential trading opportunities and make more informed trading decisions. That is it for this third video on trend analysis for traders, guys. Once you have mastered the analysis of trends, you'll soon be well on your way to a successful trading journey. See you in our fourth video, where we will be covering moving averages and their key importance in the financial markets.